Central banks should not be allowed to provide support.
Central banks put money on deposit.
The US dollar's share of global foreign exchange reserves fell to roughly 40%.
Bankers judging that the only way they can try to pull down inflation is to carry on raising interest rates.
You're going to see rising rates.
Rising interest rates that will make the cost of borrowing go up.
Most people think governments run the economy. Politicians make the big decisions. Elections determine economic outcomes. But there's a group of institutions, largely invisible to the public, that quietly influence everything from the interest rate on your mortgage to whether businesses hire or fire, from the value of your savings to the price of assets. Central banks. The Federal Reserve, the European Central Bank, the Bank of England, the Bank of Japan. But here's the question: how much control do they really have? Central banks don't control the economy the way a driver controls a car. They can't dictate growth, force businesses to invest, or make consumers spend. What they do is shape incentives. And the economy responds to those incentives, sometimes predictably, sometimes not. Here's the critical reframe: the economy is a system, not a machine. You can't simply push a button and get a specific outcome. Central banks adjust variables, interest rates, money supply, expectations, and those adjustments ripple through millions of individual decisions made by businesses, households, and investors. The result is influence, not command. Control by nudging, not directing. The most powerful lever central banks control is the interest rate. When central banks raise rates, borrowing becomes more expensive. Mortgages cost more. Business loans carry higher costs. Credit cards become pricier. The result? People borrow less, spend less, and save more. When central banks lower rates, the opposite happens. Borrowing becomes cheaper. Businesses find it easier to invest in new equipment or expansion. Consumers take out loans for homes and cars. Spending increases. This affects everything. Lower rates push up asset prices, stocks, real estate, bonds, because cheaper borrowing makes those investments more attractive. Higher rates cool asset markets as the cost of financing rises. The key insight: interest rates influence decisions across the entire economy. What businesses invest in, what consumers buy, and how investors allocate capital. In 2022 and 2023, central banks worldwide raised rates aggressively to combat inflation. The result: borrowing costs soared, housing markets cooled, and economic growth slowed. In 2024, many began cutting rates as inflation eased. The system responded, markets rallied, borrowing picked up. This is how central banks steer. By making borrowing more or less expensive, they tilt incentives towards spending or saving, growth or restraint. Interest rates aren't the only tool. Central banks can also expand the money supply, a process known as quantitative easing, or QE. Here's how it works. The central bank creates money digitally and uses it to buy government bonds or other assets from financial institutions. This injects liquidity into the system, cash that banks can then lend to businesses and consumers. The effect is twofold. First, it lowers long-term interest rates, even if short-term rates are already near zero. Second, it supports asset prices by creating demand for bonds, stocks, and other securities. After the 2008 financial crisis, central banks around the world deployed QE on a massive scale. The Federal Reserve, European Central Bank, and the Bank of Japan all expanded their balance sheets by trillions. The goal? Prevent financial collapse, stabilize markets, and encourage lending. The key insight: central banks don't just set the price of money through interest rates, they can increase its supply. But here's the catch: creating money doesn't create wealth, it increases liquidity. It can prevent deflation and support markets during crises. But if too much money chases too few goods, inflation rises. A dynamic we explored in The Hidden Cost of Inflation Nobody Talks About. Money creation is powerful, But it's not a free lunch. It's a tool with consequences. The least visible but often most effective tool is managing expectations. Central banks don't just act, they signal. They tell markets and the public what they plan to do in the future. This is called forward guidance. Why does this matter? Because expectations shape behavior today. If the central bank signals it will keep rates low for years, businesses might invest now, knowing financing will remain cheap. If it signals rate hikes ahead, investors adjust portfolios, lenders tighten credit, and consumers delay big purchases. Markets often react before central banks actually change policy. A speech hinting at future rate cuts can send stock prices soaring. A comment suggesting inflation concerns can trigger bond sell-offs. The key insight: sometimes what central banks say matters more than what they do. This is why central bank statements are parsed word by word. A shift from inflation remains elevated to inflation is moderating can move trillions in global markets, even if no actual policy changes. Expectations are a tool because they influence behavior in the present based on beliefs about the future. And central banks have learned to use language as carefully as they use interest rates. So, how do these tools work together? Central banks adjust interest rates. That changes borrowing costs. Borrowing costs affect how much consumers spend and how much businesses invest. Spending and investment drive demand. Demand influences employment, output, and inflation. At the same time, central banks manage the money supply, injecting liquidity during crises or withdrawing it when inflation threatens. And through expectations, they shape how businesses and households anticipate the future, which affects decisions today. The system looks like this. Interest rates plus money supply plus expectations leads to behavior, leads to economic outcomes. But here's the crucial point. Central banks influence the system indirectly. They don't control individual decisions. They shift the environment those decisions are made in. Lower rates don't force anyone to borrow. Injecting liquidity doesn't force banks to lend. Forward guidance doesn't guarantee markets will react as expected. Central banks create conditions. People respond, and those responses aggregate into macroeconomic outcomes. Which brings us to the limits. Central banks are powerful, but they're not all powerful. There are things they can't do. They can't control supply shocks. When oil prices spike because of war or natural disaster, central banks can't fix that with interest rates. Lowering rates won't produce more oil. Raising rates won't stop the shortage. They can't force spending. Central banks can lower rates to near zero and flood the system with liquidity. But if businesses and consumers refuse to borrow and spend, as happened in Japan for decades, monetary policy loses traction. You can lead a horse to water, but you can't make it drink. Policy takes time. When central banks raise rates to cool inflation, the effects don't appear overnight. There's a lag, often 6 to 18 months, between action and outcome. By the time the effects fully materialize, conditions may have changed, making it hard to calibrate policy precisely. And sometimes policies backfire. Ultra-low rates can inflate asset bubbles. Aggressive rate hikes can trigger recessions. Money creation can fuel inflation if overdone. Central banks operate with imperfect information, uncertain models, and unpredictable human behavior. They're guiding a system they don't fully control. And when things go wrong, the consequences are real. If central banks keep rates too low for too long, inflation accelerates. Prices rise faster than wages. Savers lose purchasing power. Inequality widens as asset prices surge while ordinary incomes stagnate. Dynamics we explored in The Hidden Cost of Inflation Nobody Talks About. If they raise rates too aggressively, they risk recession. Borrowing dries up. Businesses cut investment. Unemployment rises. Growth stalls. If they flood the system with too much liquidity, asset bubbles form. Housing, stocks, bonds all inflate beyond sustainable levels. When those bubbles burst, the damage spreads fast. And as we discussed in Why Every Country Keeps Borrowing More Money, central bank policy also affects government debt. Low rates make debt cheaper to service, encouraging borrowing. But when rates rise, debt burdens increase, squeezing budgets and creating fiscal stress. Central banks walk a tightrope, balancing inflation against growth, stability against risk, short-term relief against long-term consequences. Here's what most people miss about central banks. They don't control the economy directly. They shape the environment that everyone else operates in. They adjust interest rates to make borrowing easier or harder. They manage money supply to support markets or restrain inflation. They use language to shape expectations and guide behavior. But the economy itself, the decisions businesses make, the choices consumers face, the risks investors take, those emerge from millions of individual responses to the conditions central banks create. This is influence, not control. It's about incentives, not commands. It's about nudging a complex system in a desired direction and hoping the outcomes align with intentions. Central banks are powerful. They shape macroeconomic conditions, stabilize financial systems, and influence growth and inflation. But they operate within limits, with lags, and amid uncertainty. They guide, they adjust, they react, they don't dictate. The economy isn't controlled from the top down. It's guided through the system itself.